Thank you so much for joining. My name is Brent. I'm going to be the moderator today, and very excited to be leading this panel on credit scoring. We've got 4 experts here in the panel that I'm super excited to have here today. They've all got a wealth of experience in this space. And I'm going to jump right in. We don't have a lot of time, so let's jump in and do the introductions. So first to my left here, we have Paul Edwards from Wealthsimple. Paul has a PhD from McGill, and prior to Wealthsimple, he spent a lot of time at some of the major banks in retail risk management, pioneering AI applications for credit. And at Wealthsimple, he was the first hire dedicated to credit and has now been building a comprehensive quantitative risk management function at Wealthsimple. So welcome, Paul.
It's all true.
Next, beside Paul, yeah, applause is also encouraged. Thank you, Thomas. That's good. We have Samantha Simpson. Samantha works with me at Payson, where she's the analytics lead. Sam has built credit strategies for dozens of companies around the globe. Prior to Payson, Samantha learned her chops in credit modeling at Capital One, and she also has a Bachelor of Commerce from McGill University. So welcome, Sam.
Not a PhD. Just like 2 letters there.
Besides Sam, we have Tom, who's the VP of Analytics, Insights, and Artificial Intelligence, leading TD's Analytics Center of Excellence focused on personalization and intelligent decisioning. I had the honor of working with Tom for 10 years at Capital One in credit card analytics and data science. Tom also has a degree in statistics from the University of Warwick. And fun fact about Tom, I didn't ask for a fun fact. Tom has a dislike for pineapple on pizza. So do you want to tell us anything about that, Tom? Or?
No. I didn't actually give any fun facts. I was making it up. So.
And last but not least, on the far left, we have the president of Trust Science, Matt Browning. Matt's joining us from all the way from Utah, where he flew in early, got in 2:30 this morning for this, right? So hopefully we keep the energy up until the end. Matt's the president of Trust Science, where he's leveraging technology and data-enabled financial services to transform the experience and success of their customers. Prior to that, Matt was also COO of Snap Finance, where he took that company from early stage and grew it to over 1,000 people in 6 different countries with millions of customers. And fun fact about Matt's a hockey player. So I guess, were you excited when you had the Utah Hockey Club come to town?
Very?
Yes, very. There we go. All right.
Soon we'll have a name for the club, but it's just the Utah Hockey Club.
Yeah, I remember when they were deciding on the Raptors. They did it a little bit faster, but yeah. So yeah, hopefully you guys have a name soon. All right, so let's jump into it. So when we think about credit scoring, for years, like the OG of credit scoring was FICO. Like for years, FICO was the gold standard when it came to underwriting or evaluating the quality of consumer debt. And it was like that for many years. But recently, we've seen a lot of innovation in this space, whether that's cash flow underwriting, open banking, companies investing in proprietary AI machine learning models, use of alternate data. So I'd love to start, maybe each of the panelists have a crack at this. How are you seeing this evolution, and where are you seeing the biggest gains, whether that's coming from better data, better tools, better techniques, and maybe even more importantly, like where are you seeing just the hype or kind of wasted effort in this space? So maybe I'll start with you, Paul.
I thought a lot about this, and so I think I have to say that credit bureau data is still king. The best prediction of your credit future is your credit past, and that's still true. I think on the alternative data side, we've seen some hits and misses. You talked about what didn't work and what worked. A long time ago, people used to ask me about mining Twitter feeds and stuff like that, and that's just, I don't think that's a great idea. I'm not interested in mining your Twitter feed to see if you're a good credit customer, but I am awfully interested in seeing that you're making, in Wealthsimple's case, consistent contributions to your RRSP. That is orthogonal to credit risk data and is going to carry a lot of information. And so those orthogonal data points, orthogonal to credit bureau data, right, are going to be important. And I think in the room you guys have examples in your industries and in your own companies. The challenge there, of course, is in surfacing those within the company and correlating those to a customer. And so which of these data points within my company belong to which customers, doing all that hard work. And that's just like data engineering grind that a lot of companies need to work on. And that bears a lot of fruit when you do it, but it's brutal.
Yeah.
I've seen it firsthand. And like, yeah, I mean, I think the data science tools that are available to us, you know, we can't forget about as well. There's a lot of history of data science and a lot of tools in those tool belts that, you know, we can't ignore.
Right.
And, you know, you can't just ignore those and fall on the traditional ways of building models. You know, you don't have to dial it all the way to 11. You heard in the innovation session about gradualism. You know, the data science tool belt has like a lasso for feature selection. You can remove correlated variables and do feature selection all in one shot. And this is standard practice in other domains, right? Or like hyperparameter tuning. Doesn't matter, it's agnostic to the model. It doesn't matter if you're building a scorecard or a random forest or a deep neural net, but you're always gonna have parameters in there. And so if you can get a computer to build, you know, 10,000 models all at the same time with different parameters, you might find one that works better.
Yeah.
And so we can't forget about these standard tools that are best practices everywhere.
That's great. Sam?
Yes. I was going to say in terms of gains, just the availability of everything you mentioned, data, tools, techniques, are just way more democratized across the whole spectrum. It's not just banks anymore that can have access, right? Everyone has access to data. And even now, the bureaus have specific teams and offerings dedicated to fintechs, right? That's new. And so that would definitely be a gain across the industry that I've been seeing. And then on the hype side, similar to kind of what Paul's been touching on, we often work with clients, Brent, you can attest to this, where they're so eager to use alternative data, right? We hear it first out of their mouth. They want to mine social media. They want to use that. And it's not to say that it has no place. Definitely can add a little bit to your models, but it's not replacing credit performance and it's not replacing financial data. So a little bit of hype there.
No, I agree with both you and Paul. I think it's not about replacing credit bureau data, it's like augmenting it, right,
Exactly.
for sure.
Exactly.
Tom, what do you think?
Yeah, I think one of the things you said in the question was how a lot has changed, but I actually think a lot hasn't changed. I think the themes around credit modeling are the same as they've been for a really long time. There's kind of three things you kind of said in your question: the data, the techniques, and the integration of technology. I think those three themes have been there ever since I've been doing it. So for example, 10 years ago, we were looking at new innovations in data, getting mortgage data into the credit bureau, remember that one? Adding telco information, things like that. To now, we're looking at open banking and, remarkably, using your own deposit data to actually make credit decisions amazingly. So the data question's always the same, it's just changing. On the technique side, it's always been a question about how you evolve that as well, right? You know, 20 years ago, we started with FICO. We were talking about scorecards. You move to logistic regression. You move to gradient boosted decision trees. You start looking at things like competing hazards. So like those things have always been the case. And now it's predictive AI and how do you use that to actually make better decisions as well. And then the technology is how do you actually implement these things, particularly at large banks where you have legacy systems. Michelle and I were talking about that earlier. And how you actually get those things into production and you actually utilize them. What has changed is the pace of that change. So the amount of data that you're seeing now is exponentially growing all of the time. The technology integration is a lot easier. The techniques, you're getting more access to more talent that can do these things. And then also, organizations are actually starting to see that if they don't innovate in these spaces, that's where they get left behind. In terms of what I'm most excited about, in Canada in general, I would say open banking data. So actually using the traditional sources, just more of it, is going to be really useful.
Yeah. You make a really good point about using your own data. I think the banks can do a better job at using their own data because ironically, sometimes it's easier to test external data than test your own data, right?
So true.
Yeah. Matt?
A lot of good things from the panel here. I think the different take that we look at it at Trust Sciences, it's so much about the data. Again, the technologies, the techniques, they've been around a long time. They're in some ways commoditized because those best practices are so well established. For us, it's really about the data, and we, as we like to say, we like to find the invisible primes, those subprime consumers that will perform like a prime borrower, so lenders can say yes without taking undue credit risk. But it's about bringing different kinds of data or treating it differently to bring better resolution into those credit decisions. And so for us, it's always about the data. The technologies and the techniques are very solid. You need to, I mean, they do evolve, but it's really about the data. And I'm sure we'll get into more of that.
Excellent. Well, we talked about the evolution kind of the industry as it pertains to credit scoring. Let's talk a little bit about the evolution within a company. Like when you start, and Sam, you know this, we work with a lot of startups or large retailers that are looking to launch an embedded finance solution. So they're building a product from scratch. And it's a bit of a chicken and egg thing. If you don't have performance data, you can't build models, but you need models in order to book quality loans to get performance data. So maybe Sam, take us through a little bit about how, with your clients, how you kind of approach building that roadmap, or kind of what's your version 1, version 2, version 3, as you eventually build up data and build out your sophistication, I guess.
Yeah, absolutely. I'm actually curious, how many of you here today, by show of hands, are a lender? That makes sense at the CLS. Okay, fantastic. So most of you, and so you're probably at different stages in your journey. Some of you may be mature or just starting out. And so when we're working with these new companies that are launching kind of their first credit product, so V1, as Brent mentioned, there's no to limited data, right? So we're helping them build a model, quote unquote, that's basically a simple decisioning tree, and that helps tranche your population into some simple segments, low, medium, high risk, maybe a few more granularity, and you'll give them different treatments, and you'll test that in market, and you'll kind of grow your data that way. So that's V1. And if you have no data, like you can't even get bureau data on your population because they're unbanked, you might be going just off of what's on the application form, right? Like that's your V1 or V0. And then as you're kind of growing and you get to about 1,000 loans, you have 1 to 2 years of performance data on your population, you have good customer metrics, you're able to then build your first proprietary risk model, right? So it'll be a simple linear regression because you only have a handful of loans, but it's something to kind of augment that segmentation that you have in market and really help you kind of get a little bit more granular in the treatments that you're giving different customers. Because at the end of the day, these models are really used as an input into your credit decisioning, right? So who do you approve for how much, for what type of loan, and you really want to get that matching right. And then as you kind of head into V3 or maturity, you're really reaching kind of 100,000 loans and you're building your first GBM model. And then at this point, you're also looking at different models. So you want more products, you want a customer management model, you want a response model, revenue models, right? Like you're just getting more sophisticated across all of the inputs that go into your credit decisioning. So that's a little bit of kind of high level. And if you want any more details on that, come find me later. We only have a half hour here. Love to talk about it. But we do work with kind of lenders at all stages. 3 things I'd like to kind of impart on you for the beginning stages. When you're going from V1 to V2, you do not have to wait until V2, that first proprietary risk model, to start making changes to your policy. Monitor and adjust as you go. It's so imperative. You want to be testing that what you've put into market with that simple segmentation is actually in line with what you were expecting, and if not, adjust. And then the second piece is, if you're just starting out, to not freak out your investors with massive losses, try and go after your low-risk population first. It shows that you know how to identify them, and you can kind of validate that your risk is within your expectations, which is a big plus, and then you don't have like ballooning losses right at the beginning of when you're launching something new. And then the last piece, I am blanking on, but there was something.
Oh, well, I liked your question asking an audience who's a lender out here. How many vendors are there in the audience here? Okay, see, that's a good rate. That's a sign of a good conference when you have that lender to vendor ratio. That's good. So.
Oh, wait, okay, I remember.
Okay, go ahead.
Because I looked at my cheat
I
card.
was
Yeah.
just stalling for you.
Yeah, I appreciate that, Brent. Thank you. Thank you. It's teamwork. It's just considering the pros and cons of the first product that you launch within your credit sphere. It might not be your target product or what you envision for your customers, but it might be the right product to learn quickly on the risk of your population. So there are some, trade-offs to consider at the beginning there, that some products have faster learning cycles, they're simpler, less complex. And so that might be a good place to launch, even though eventually you're picturing credit cards, you're picturing, something very unique. Might be good to start with something that gets you learnings.
Excellent. Paul, you're living this right now at Wealthsimple. You're going through this. Well, how are you thinking about it?
I live this every day. I guess like maybe a little contrast to what Sam was talking about, where you've got like absolutely zero data because your customers may not have a credit bureau. we do typically find that our customers are banked and have credit bureaus. And so like, but we are facing this cold start problem now, and I'm living it. And so like, a few interesting lessons maybe that may help some people who are in the same space is like buying that first data set on our customers, from the bureau was like a good exercise in shaping the product, right? Because that first population, on whom you want to build your first model, those are going to be the first people you need to adjudicate. And so you need to really refine, well, who do I want to know the most about? Who do I want my model to work best on? And it forces you on like, well, which product do I want to launch? If it's a card, is it a retail card, like a store card, okay? Or do I want to scrub those out? Do I expect customers to be, at a national scale, or is there a province on which I want to focus? And, you have to specify all of those things, and like, what's the target that I really want to know? What am I actually trying to model? And so that was a great exercise in refining our early product design, in parallel to refining, the first version of the model, which was great. And then we had to kind of hedge expectations internally about this. We were talking about correlating data and finding other data points, within your own walls. We had to kind of hedge internally on that, because whenever you do this, of course, you get anonymized data, as you all know. And so correlating that anonymized data on your very first version of your model is impossible. And so you're flying a bit blind on the internal data, and you have to just wait. And there's nothing you can do except for wait for the first performance, the first payment data to come in, and then you can start to correlate it back. Right. But regrettably, that data is not available to us, on day one.
Yeah, that makes a lot of sense. Matt, I want to talk about data for a second, because as you know, data is the oxygen for credit scoring models. And historically, credit scores worked really well on prime or super prime populations because they have very thick files. There's a lot of credit data. But subprime, maybe not so much historically, as a lot of those non-traditional loans or subprime products weren't reported to the primary credit bureaus. But I think that's a space that's also evolving. Can you tell us a little bit about what you're seeing in terms of increasing the availability of data and how companies like Trust Science are leading the charge there?
Yeah, the markets are, so if I contrast the US and the Canadian markets, my experience has a lot of depth in the US market, where there's a lot of alternative data bureaus. Canadian privacy laws inhibit a lot of those alternative data sources. So again, I think the main bureaus in many ways are still king here, but there are ways to take that same data and apply it differently. And at Trust Science, we are a bureau ourselves, so we're a CRA across the provinces and whatnot. And it's working with a range of lenders to get that performance data, that we get a lot of the data that isn't reported to the big bureaus. And so it's combining those in novel ways in very specialized areas, so specialized verticals of lending that help us bring resolution to those subprime consumers. Again, it's about the data. I think open banking is clearly one that will unlock an awful lot of data. In Canada, it's not as matured as it is in the US, but unlocking what goes on inside those bank accounts, whether that's payments out, cash flow in, to look at income in new and novel ways when people have more than one source of income, and how do you combine those and look at them in aggregate and stability over time. Those are the things that we're really excited about, for sure. And ultimately, if I look into the future, where does consumer permission data allow us to go so consumers can port and bring their data along? Right. That's looking into the horizon a bit, but it's all about the data and seeing what consumers actually perform, and there's other ways to get at it than just the primary bureaus.
Right, excellent. Let's talk about testing a little bit. So Tom, we know testing is a huge pillar of building effective credit strategies. It's important to do foundational testing, not only to eliminate blind spots in your model, but also to really understand the difference between causation and correlation and treatment effects and from line strategies and things like that. Tell us a little bit, but even though it's so important, I think what we find is not many companies test really out there, and then the ones that do, not many of them test effectively. Tell me a bit, Tom, about how you've built that muscle up, like at scale at large organizations like Capital One and TD.
Sounds good. Thanks, Brent. So as you know, and I'm a statistician, as Brent mentioned at the beginning, testing, super passionate subject for me. It's something that I hold really close to my heart. And everywhere I go, I try to instill that culture around in terms of testing. I think, speaking to this audience, many of you will already know the importance of testing. We have world-class credit strategists in the audience, like Ardalan here, who, and many of you similar to that, will know all about the importance of getting that oxygen for the models. Yeah. I think the one thing to kind of highlight when it comes to credit testing, foundational testing is really scary. And it's scary for a lot of organizations, but it's necessary. And it's necessary to get those learnings to understand how to optimize not just credit risk, like the actual losses that you get, but also line assignment and things like that. And I think that's an incredibly important thing. What we've done recently at TD is we've stood up a Test and Learn Center of Excellence. And so this is a center that really drives the quality and the execution and the culture around testing at the large organization, and empowers groups across the bank to have a consistent way of doing testing, consistent frameworks and tooling, but really is focused on driving that cultural change. Like, how do you actually make people understand the oxygen that you can get from the testing?
Excellent. And we got Thomas here from the Center of
Excellence.
Excellence.
Thomas is from the Center of Excellence.
Excellent. One thing, in the past, building the model used to be the hard part, right? But today, with the Python libraries and everything, the building the model is not the hard part. The software will do most of the work for you. The hardest part often is getting your model prioritized and implemented. So I've seen many really powerful proof of concept models die on the vine because there just isn't that political will to figure out how to get over to the finish line. So Paul, you're at a fast-moving fintech now. Paul, you are at a fast-moving fintech now, right? But you've had lots of experience working at bigger banks where you were really pushing the bounds of new models and new techniques and trying to get support and sponsorship for that. Tell us a little bit of your advice on, like, how do you best navigate maybe large organizations to make sure that credit modeling is prioritized appropriately and you have the political will to get things implemented?
With apologies to Daniel Kahneman, I'm good at thinking fast and slow. There's rarely, I never have a hard time finding work in credit. Like, there's always work to do. These models are, the shield these companies from the elements, and so no one's really going to blink twice if you say, hey, my model's degrading, can you patch it up for me? Like, that tends to get attention. But some of the, I have also seen I've seen a lot of things die in the vine, as you have, and a lot of those complex models that don't land anywhere are sometimes ill-conceived in the first place. And the answer isn't always to build the most complex model. You heard, I think Jason spoke about it quite well in the last innovation panel. You don't, I'm wary of a hammer looking for a nail.
Right.
And I'm very attentive to, a very tactical decision of when to walk and when to run, and what's the appropriate level of complexity. That's the challenge. I've had mixed success with it myself. I've had projects die in the vine, absolutely.
Yeah.
And I've had some successes as well. And where I've been successful has been sort of thinking from the outside in, where the model is last.
Right.
And building that cross-functional buy-in before you build the model, because the models are easy to build now, right? Like, that's the easy part. But you have to think about the implementation challenges, the return on investment, the regulatory challenges, and work your way into finally building the model.
Right.
And that's a better path to success.
Excellent. Matt, from the vendor perspective, like, how do you work with your clients to kind of help them build the business case, like, so they can take it back and get the investment?
And this is, I talk about risk and risk adjudication. You're sort of operating on the heart on a live patient, right? It's kind of scary. And so I think to the points that were made here is I use the KISS method, keep it simple, stupid.
Yeah.
But test, as Thomas mentioned, if we can all just learn to test a bit and take it in small steps, it's testing, and have a culture of testing. You're going to learn, you're going to fail. Do it in small increments so that when you do fail, it's not a big splash. But having tests that can run silently. You can do the retro studies, you can run models silently in production watch them perform. And that's really the approach we take with a lot of lenders and banks. And it's not a rip and replace. It's not this or that. It's this and that. There's a mention on orthogonal data. It's something that's a little different that you add on top. It doesn't change the whole game, but that incremental add is what brings lift. And those are easy ways to test in small increments. So testing, please test.
Yeah, I agree with that. All right, last question that we're going to have open up for Q&A. But Tom and Sam, you guys are kind of experts in this area. When we talk about scoring, we often are talking about the credit score, the machine learning model, kind of like the sexier part. I know that's an oxymoron, but there's also this like more boring part of, you know, what do you do once you have that score? Like that's where you're into the Excel, figuring out the right segmentation, figuring out, you know, how to use your test data then to assign line appropriately. And that's really where the money is made, isn't it? So can you guys talk a little bit about how you actually pick up from the model, and then what is some of the best practices in order to monetize these models?
Do you want me to go first?
You said you wanted to go first.
Yeah, I do. Just kidding. So yeah, it's a good question. First of all, I don't think that's the boring bit. Like this is to me, that's the exciting bit, right? If you want to turn your super sophisticated model, the thing you spent all that time on and effort to get through, into value, this is the bit that really matters. And the companies that do this and do this really well are the ones that will win at the end of the day. And so it doesn't matter sometimes how great you are at splitting risk. If you don't use that appropriately, you're not going to drive value for the organization. And that's probably the most important thing. And so from my perspective, understanding the full performance of the loan, the full cash flow, everything end to end, not just the credit risk, is super important to make and drive excellent decisions. And I think that's, it also requires a lot of testing. Again, like make sure you got the data to do it. And at TD, we've recently stood up a valuation center of excellence that goes hand in hand with our test and learn center of excellence that really focuses on that full understanding of the decision you're making, whether it's a credit decision, a pricing decision, or a marketing decision. And I want to give like a shout out to Payson. You guys have been on the road with us and like helping stand it up, particularly Sam, who's helped us develop those first versions. So you have a lot of experience. Maybe you can share some.
You're queuing me up so well.
That's why I want to go first.
Thanks, Tom. So yeah, I mean, I totally agree. As I kind of mentioned earlier, risk models are kind of the cornerstone, right, of credit decisioning, and so you're using it to kind of create segmentation. But then you also want to tack on some sort of valuation methodology on top of that to understand the value that those segments are driving. And then with testing data, right, you have a better sense of the subtle relationships between different behaviors on your credit products, which can be quite subtle in terms of, you know, adverse selection and things like that that can happen when you are changing your policy that's in market. And then the second thing that I would mention is just monitoring, right? Like all of these things are, you're kind of running blind if you're not monitoring your credit performance, everything that's going into your cash flows, as well as the risk models themselves.
Excellent. I think we're almost at time, so thank you, panelists. But I think we have time for maybe one or two questions if we have from the audience. Yeah, Manas.
Yeah, absolutely. Time's a really good one, right? So if you think about you want to launch international student loans, as an example, right? That can have a really long time before you're getting any reads, especially if you're giving a deferral period, right? So maybe you want to start with some other type of small personal loan, something smaller that you can get those credit reads a little bit earlier on that population. But there are also other dimensions, like you could add a securitization feature, like maybe eventually you want to go unsecured, but you don't feel comfortable doing that from the beginning, so you can build in a securitization factor at the beginning. You can play around with, you know, you want to offer revolving credit eventually, but maybe it's a little bit safer to do something different earlier on, right? So there's smaller amounts, smaller durations, all those things, and it obviously depends on the space you're playing in and what you're looking to launch, but there are perhaps a V1 version to kind of gain the learnings that you need if you're really going in blind and you don't have a lot of data to kind of help you build that faster. And also just there's a lot of complexity within credit, right? Like compliance, things like that come into play, even accounting regulations to keep in mind depending on the complexity of your product. Yeah, thanks for your question.
Excellent. Yes. Right. Yeah, for those who couldn't hear, if I could paraphrase, I think the last 3 or 4 years, the data's a bit messed up because of inflation, maybe COVID effects. How do you deal with that, the last 3 or 4 years of performance data, and still be able to model off it?
Let's give it a go.
Go ahead, Tom.
Oh boy, that's a hard question. Thank you. No secret sauce coming out, but I think it's a really, really complicated question, and these are the themes that we've had historically when we've been developing models and credit strategies, where you really need to understand the biases in your data and the inputs and how they're changing over time and what that impact has. Back to my point on cash flow monitoring and analysis to inform really good decisions, one of the things we're really grappling with right now, it's similar to what we've seen through COVID, is the effect of margin changes, right? So like the cost of funds are changing all of the time. The interest we're getting from customers is changing. So how do you actually value those decisions and understand what the impact is going to be going forwards? And so I think the summary to that is it's not just the model. You can't trust the data to tell you what's going to happen in the future if the future's not going to look like the past, right? And I think like understanding multiple samples, having manual overrides, having second order effects that you don't know about as well, and having sensitivity to your decisions, super important. Understanding what those sensitivities need to be and which ones are most important, that's why you guys all have jobs, right? Yeah.
Excellent. I know I think we're at time, but this has been such a great discussion. Thank you, Paul, Sam, Tom, Matt, and thank you for a great audience. Enjoy the rest of the day here.
Thank you, Brent.